Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I am thrilled you're here. You guys are really going to enjoy the gentleman we're interviewing today. I actually interviewed him previously, and when I was interviewing him and my friend Jack Bosch. His name's Corey Peterson, and Corey's the owner of Kahuna Investments, and he's got over 1,275 doors, a $95 million portfolio, but he's just a dynamic guy. So we're going to have a lot of fun today. Corey, welcome, my friend.
Thanks, Rod. Thanks for having me, brother.
Absolutely. So are you the big Kahuna?
Man, I think I am.
Love it. I'm sure that's the only time you've ever heard that joke. So talk about how you got started in this business and just how you got to where the success that you enjoy today.
Oh, thanks, Rod. I got in this business like most people. I had a dream of wanting to get rich in real estate. I didn't start successful. I started off as a poor country farm boy, not voted most likely to succeed, barely, didn't even go to college, no college degree. I sold used cars.
Wow.
But something happened magically about 17 years ago. I was like 32 before I got the download from the mothership. But my mom was married to this man named Bruce. Now I call him Bruce Wayne. Now he's not
Batman.
He's not Batman, but he was loaded. And he had a house right in Hawaii, and Mom invited me and my girlfriend, now my wife for 17 years, to go and visit. So we get there, and this guy's got fine art, nice cars. I mean, he's got a home right on the beach.
Wow.
And I remember going out watching the sunrise, and the waves are rolling and crashing in the spray. And it was like a light show magical paradise. And I'm sitting over and I'm looking across the cove to his house. And I'm like, what does this guy do? And guess what he said? He said he does real estate and he owns this apartment complex.
Wow.
And now I wish the story got better, but Bruce was a prick.
But you got motivated.
But I left the island saying he was the big kahuna.
Love it. Okay.
And so in 2005, I read Rich Dad, Poor Dad, that book by Robert Kiyosaki, and that book changed my life. And all I could do is think about that's exactly what Bruce does. Mm-hmm. And so I started my company. I named it Kahuna Investments because I wanted to be the big kahuna.
Love it. Love it. Love it. Love it. Love it.
But, in that journey, I started off as a wholesaler first. I started wholesaling.
Single family, I take it.
Single family homes, right? Because I had no money, no credit. That's where I started. And then I learned how to raise private money. Now, my actual background, I got away from selling cars and I become a financial advisor. So I was Series 7 and Series 66 licensed. I got trained by one of the best people in the company, in the business called Edward Jones, on how to raise capital, how to find money, right? Nice. And but then the market crashed. It was a world time to be a financial advisor, right. And I went full time into real estate in 2009.
Oh, perfect timing.
Also, then I learned this thing called OPM, other people's money, private capital. And once I learned and used the same skills that I was taught to me as a financial advisor, and then I got to use it for myself, I went hog wild. I started doing lots and lots of fix and flips until I had my next problem, which was I became a workaholic. Mm-hmm. So bad to the fact that I was not happy. I was not living what I call, because Bruce gave me a perfect vision of what life looked like, because his phone wasn't ringing. He was making money, living in Hawaii, living a great life. Here I was every day I was like a Lowe's parts runner, right? Chasing my tail. To job after job, and got so bad that one time my son's like on a Friday night, Dad, are you going to be at my game on Saturday, 2:00? Yeah, son, you can count on me. And but inside I was like, I got to look at 3 properties, and so I wake up early that morning to go look at these 3 properties to make sure I was going to be at my son's game at 3. And long story short is, I made it to the end of the game, and dude, my son came off the field and he was crying.
Oh, wow.
And he said, Dad, you promised. Wow. And you want to talk about getting crushed. That pinnacle of, you would look at me and say, Corey was super successful, right? Making money, but it was at a cost of the hustle and grind of that business model was tearing me apart, and hurting the people that I cared about most, which was my family. And I remember, I mean, dude, I grabbed his head in my chest, and he's, oh, I felt this is my boy.
Right. Yeah. No, that's miserable, man. I tell people my biggest regret in life was, I'd come home to this, this $8 million house on the beach that I built, and I'd play with my kids, but I was distracted, and it was my greatest regret in life. And to this day, the kids tell me I was a great dad, but I didn't live up to my own expectations,
Yeah. So this is what was happening. And then in that broken state is something happened. I'm actually driving my son home. Kids are resilient. They still forgive you, even though when you suck. But he still wanted to get in my truck and ride home with me as he's sobbing right there. And I'm like praying to God. I'm like, God, forgive me. Right. And I drop him off, and I'm like, I can't just sit at home. I got to drive. I've really messed up here. My wife gives me those eyes like, you better fix it.
Right.
And so as I'm alone in my car and just asking for forgiveness, I finally find some peace. And in that broken down state, I drive by this apartment complex, and I've driven by it it's on my way home. I've driven by it 1,000,000 times. And I used to say, I wish I could own an apartment complex. Mm. But in that moment, in that broken state, I asked myself a question. I said, how can I own? And once I did that, Rod, my brain started working, and it started formulating, like, what do you know about real estate or commercial? Not a whole lot. Where would you go to find information? I went to Barnes and Nobles. I went and bought books and started getting, and dude, from there, and so in 2011, I bought my first apartment complex. I bought it for $3.2 million. I raised $1.4 million in private money. I was already good at raising private money.
Right.
Transitioned that capital. By the way, so at 3.2, I bought it for $3.2 million. I sold that property last summer, 5 years later. I sold it for $8.8 million.
Holy cow. Home run. Well, you bought it at the right time. I mean, that's, I want to circle back to a couple things you said, and I want you to continue your story. Your background is just freaking perfect for this business, because not only did you sell cars, which is, probably, the epitome of sales, but you also had a finance background. So it's just absolutely perfect for this business. And that story with your son, guys, those of you listening, self-disgust is a pretty powerful freaking motivator. Okay. And I actually did a driving force clip on this. I call them Own Your Power now, but utilizing emotions for change, and disgust is a powerful one when you're like, I could have been a better father in your case. And you reach, and it's really like an epiphany. It's like a moment where everything changes, everything shifts. So awesome story. And the other thing I want to circle back on and just draw some attention to is the questions that you asked yourself, because you used to say, I wish I could do this, or I should do that, or I'd sure like to do that, or God, that, I wish, and we should all over ourselves. And you just asked a better question. And the quality of your life is based on the quality of the questions that you ask. So some awesome nuggets you gave us there, brother. So you close that apartment complex, and the rest is history. So you self-taught yourself, which is very impressive as well. And so, let's dig in to money raising, because we chatted about it before we turned the recorder on, and I think we can add some real value, and so, in most syndications, you'll offer a preferred return. Like, we're raising money on 2 awesome deals right now, one in Texas and one in Louisiana. And we're offering a preferred return and then a split. And I can mention this because it's to accredited investors only. And just so you know, if you're interested, certainly love to talk to you about it. Just text partner to 41411 and we'll chat with you about it. But what I want to get into is this strategy that you chatted about. And I heard, what's interesting is I actually heard a version of this at my boardroom, one of my boardroom meetings. But without stealing your thunder, the typical deal is, you'll pay a preferred return and then you'll do a split. like, anywhere from 80-20, even 90-10 sometimes I'm hearing, but to 50-50 is typically, that's the range, anywhere in between. We typically are in the 70-30 range, where the investors get 70% of the deal and we get 30% as the general partners. Now, so you'll typically, pay that preferred return every year, and then you'll split any disposition fees, be it a refinance, a sale, whatever. When you have a liquidity event, and you'll split it based on those percentages.
Yep.
So I won't steal your thunder, because I heard a version of this before.
And that's absolutely true and accurate. What you just said is absolutely true and accurate. And that's just one way to do it, right?
Mm-hmm.
Now, what I go back to how I was trained as a financial advisor, right? And I was like, well, if I look at the avatar for people that are putting money in stocks, bonds, and mutual funds, right? I go, what's the return that they're expecting, right? And this is kind of how I developed my little process was, and
you backed into it. Love it.
I already knew this, right? Because I was a financial advisor. And when you first start, when you're a new financial advisor, you say 10, right? Oh, I'm telling my investors they need to make 10%. When you become a seasoned financial advisor, you never say the word 10 in your life, right? You say 6 to 8, or you probably say 6 to 7, right? So if somebody would say, hey, Corey, what kind of return can I expect? Or what's a solid return that if I could get year over year, what would be that, right? And I would say, listen, if you can get 6 to 7 or 6 to 8%, that is money. That is a solid return. Okay. And that's what these financial advisors are telling their clients. Okay? And that's a fact. And because the reason I say the new guys, they want to sell the pipe dream, but the seasoned guys, they know that if you promise too much and you don't deliver, money leaves the door. Right?
Always under promise and over deliver, guys. And this applies to everything that you do in life, because then everybody leaves happy. So good.
So the other thing that I looked at, so when I looked at what was my biggest trades as a financial advisor, like when I placed money in different investment vehicles, right, where did I get the most? And it was always fixed income, right? So our bond funds, and there was this guy, his name was Brian Bertucci. And he was a rep for Franklin Templeton bond funds. And I love this guy, big New York guy, bigger than life attitude. But he's like, Corey, the reason I like the bond fund is because it's always big, sticky money. And I don't know why that stuck with me, but the way he said it and the way he pitched it, but it's the truth. My biggest trades, when I was putting in and investing these people's money, the 70% of their investments of the total was going into the bond fund, and like 4.5%, 5% returns, maybe sometimes 3, right? And they just wanted it to make an income stream, especially if they're retired, right? Because Wall Street can help you raise money, but it's not really good on providing an income stream, right? And usually the income and most advisors would tell you, hey, if you can live off of 3% of your money in interest, that's what you would want to do. So that's a 3% of $1 million is 30 grand. Well, that's not a whole lot of money.
No.
So now I switch that to the apartment. How I create my syndications. Okay. I give a 6% pref, right? That's on the front. It's based on cash flow.
Right. So that's a yearly return, comes off the top before anybody gets anything. As far as the investor pool, they get their 6%.
Yep. So that's usually how we structure it. 6% pref, right?
Okay.
Very simple, understood. Now, and how I pitch it or I sell it is, listen, guys, to the people, I've said, hey, listen, if you were getting 3% from let's talk about your investment. Let's just talk about the stock market first. Right, I always base everything on the stock market because that's the avatar that I can beat all day and every day, right? And so, and I say because I want their IRA money, I want their safe money, right? And so, as I go into that discussion, I'm like, we talk about that, what's out there investment for safe money, and we talk about CDs, Treasury bonds, right? And we finally get to corporate bonds, but the most we ever get to is like 3% return. I let them tell me the return that they think they can make on those investments, right? If they're somewhat smart. And then I say, well, after that, what's your alternative? And they say, well, blue chips. I go, oh, well, now you're back in the stock market. We already know that's a roller coaster. And they don't want to get on the roller coaster with their safe money.
Right.
So I said, guys, what we do what we're really good at in my company is providing consistency in return. And we pay that 6% pref. And in fact, I can almost double your income right now. And we pay quarterly. So show me an investment out there in Wall Street that can pay you a 6% payer that gives you quarterly checks. There is not one that I know of. Right. So I'm like, if that's all we did, that would be amazing. Would you agree? I just doubled your paycheck. And I get them to start shaking their head. Yeah, you doubled my paycheck. And then it's kind of like my car salesman can't help it. But wait, there's more.
There's more.
Now, one of the things about these apartments, because apartments are like factories, right? We put in rent checks, and they spit out profits at the back end, right? Mm-hmm. That's what's coming out the back door is profits. And so, the one thing with our renters is our renters expect rents to go up each and every year. And guess what? I never disappoint them, right?
I love your altruistic heart, my friend.
I never disappoint them, right? And so, but when we raise the rents, that increases the value of our properties, right? As long as we keep our expenses tight, that's the job as a goal as an operator. That's what we do, right? We go in there, we fix problems, and we make things better. We increase the rents and keep expenses either lower or tighter, or we manage that stuff, and we grow our NOI, or net operating income. And when we do that, we pay an additional. So then we have eventually we're going to sell the property.
Right.
And when we sell the property, I pay an additional 6% return. Now that's not guaranteed, by the way. I just say, and the way it reads in my PPM is a 6% pref on cash flow, and then upon sell, it's a 50-50 split until the investor gets a total return of 12%. So my investors will never make any more than 12% on my deal. And so guess where all the other upside goes to? Corey Peterson. Okay.
Corey Peterson.
Now,
I got to tell you, I'm smelling a little used car here. I just got to say. Let me ask you this. I mean, that's a phenomenal model. And let me tell you why it's successful is, when you're trying to explain some of these complicated syndications to investors with waterfalls, if we hit this mark, it'll switch over to this and they just want to know what they can expect, what they can take home to the bank. And that's why your model, although it limits their return, is very comfortable for a lot of people because again, this is, like you said, this is their safe money. And so, would you agree?
With that, so here's what I learned, right? So there's different types of thought processes on this, right? I'm in business for Corey Peterson, and my goal is to make sure that I protect my investors and give them a solid return. Right. If I can be consistent and solid and do it time and time again and prove that through track record, right? I do not have to give up the moon, right? Listen, we all know there's China money out there, right?
Right.
And, what is money from different countries, if you could give them, I know some hedge funds that they get money at like 1% from China, and so whoever has the lowest cost of capital, in my opinion, wins.
Wins, no question, which is, if you see these insurance companies and these big REITs that really have no cost of funds and they can buy a 2 or a 3 cap.
So I say, why can't we do that, Rod? Like, why can't us as the individual syndicator, the real deal makers, by the way, because it's not Wall Street. They're horrible deal makers, right? We both know how to find, attract, and work and fix these products way better than I think Wall Street does.
So your model, just so I understand it, so they get their 6 pref and you are at 50-50 through the life of the deal. And so anything over and above the 6 pref is 50-50 through the life of the deal, or do they get more than 6% pre-sale?
Nope. They only get additional 6% annualized, right? So it's a total return of 12.
I got you.
Return of 12.
Okay. So it's 50-50 every year up to 12% for the investor.
Yep.
Gotcha.
Now the beauty of it so we define 2 things. So ownership wise, we define it, they get a 50% ownership in my LLC. So we create A shares and B shares, and they get it's a 50-50 split in ownership. Now, the reason that's important because they get 50% of the depreciation, right? Mm-hmm. But when it comes to payout, we've defined the payout to be our 6%, and we just say it's 6 and 6, right? It's 6% pref and 6% annualized on the back end. And then as long as we meet our sell goal, you should get a total return of 12, right? Mm-hmm. Now, if we don't, it could be less, right? But they understand that. We fully disclose what that process looks like. But I just raised $3.6 million on a deal. Then I just closed on a $4.6 million raise. We did another 1.8, and I'm raising this capital.
Do you get a lot of pushback, like from the more seasoned investors that have been in deals where, there's no cap on the back end? Is this work better with people that haven't, invested previously?
So yes and no. I get both, right? So so it's a mixed bag. So I just go back to my avatar and I say, when they say that, when they're like, hey, well, I'm getting this and this and this. And I'll go back and explain my model. Like, listen, that's not who we are, right? We're really good at providing consistency. And I would say this is I call that your speculation money, right? If you want to put your speculation money, go do what you want and try to get those 25, 30% returns. It's great. But if you want a consistent return, this is the bucket that we do, right? And this is how we do it, right? And so typically, for us, we don't buy vacant buildings. We buy stabilized assets, 85%.
Same here. Yeah.
Yeah. And so, but I guess now here's what I've learned in this business. Now, none of this would have happened unless I decided in my mind that that's how I was going to attract it, right? And as soon as I open up my words and allow my mind to believe that it's possible, because I used to do like the traditional model, which you just talked about.
Sure.
Right. And now, so I used to be at 8. So you had Jack and I on a deal almost 2.5 years ago, I want to say, right? Maybe almost 3 on your podcast.
Right.
We did the deal together. That was 8 and 8. That was 8 and 8.
8 and 8. No kidding. Wow.
I'm at 6 and 6 now, brother. Right?
You're heading the right direction. You're heading the right direction. I love it.
My next deal I might go to 5 and 5. I'm going to keep challenging my cost of capital because I know if I get a lower cost of capital, Rod, it allows more deals to qualify.
Sure it does. You bet it does. It puts more deals on the table.
And a cash flows. Now, we still have our internal metrics. Like, we don't want to just do skinny deals. We want to do fat deals.
Of course.
But but what I'm saying is it just gives you opportunities to take something that may not cash flow as much in that first year or two and turn that into a gem.
Yeah, love it. So what is your avatar? Now, guys, if you don't know that term, that's the target person that you're going after for investors in this case, as an example. I mean, it could be other things. I've got avatars as it relates to my thought leadership business and my students, because you see patterns. You see, it looks like most of my people, are between this age group, they're this gender, they're on and on. They have this income this is their income demographic. And that's how you create what's called an avatar. So what's your avatar, Corey, for investors?
So doctors, dentists, chiropractors, busy working professionals. Investments for busy people, right?
Do you just do accredited, by the way, or do you also do 506B?
506B is only.
You do 506B. So you develop a relationship first.
My whole process is built on relationships.
Okay, I want to talk about that for a minute, but back to your avatar. So you got busy professionals,
right? And then anybody that's in an IRA, which is almost everybody.
Okay, anyone with an IRA. Okay, all right. Now, So you do, so guys, those of you who aren't familiar with, there's really two, well, there's three now. There's also Reg A, but there's 506B, which was what I grew up on, and as a syndication, which allows you to bring in sophisticated investors. There's a sophisticated, there's accredited, and there's the ones that you don't want to deal with, which haven't got a clue about money. And sophisticated, they own a business, or they've got some business acumen. Now, with the 506B, which allows you to bring in sophisticated, you have to have a previous existing relationship. And they used to define it as the 3-touch rule. You had to talk to them 3 times before you could present a deal. Now, so that's what Corey's talking about here that he utilizes. We use the 506C, which requires us to only bring in accredited investors. And, they have to have $1 million net worth without their personal residence or make $200,000 a month in income. A year, forgive me, $200,000 a year in income. And so that's the 506C. Now, there's another one out there now called Reg A, which allows you to actually bring in sophisticated and accredited, but it requires an SEC approval. But so you do 506B. So let's talk about how you develop those relationships. Now, I know you've got your podcast. Talk about the framework that you take people through. I know you use the podcast to bring in investors. Yeah. Talk about the framework that you utilize.
So there's a document called Citizens VC that was kind of I'll even share it with you.
I mean, could you repeat what you just said? Because I didn't quite catch it. Citizens what?
VC, okay. Venture Capital, I believe is the name of the company.
Okay.
Where they sent out a letter to the SEC and said, here's our process. If we do this, this, and this, is it correct? Right? In a way that they were educating, right? But they weren't advertising, right?
Got it.
Like, so a podcast we're educating on our podcast, right?
Sure.
So of course you can drive people to your website. Hey, if you want to learn more, and in that document, and I'm going to give it I'll send it to you after the show.
Awesome.
So you can use it. It details, it's a letter to the SEC explaining the step-by-step process. And it comes back with a response saying, if you do it this way, then yes, that is the correct way.
You're in compliance. Okay.
Yes.
Okay. No, I'd love to see that.
And what that here's the kind of the high level breakdown.
Yeah, give us a high level on it. Yeah.
Right? You come into my website, Kahuna Investments. It's a membership site. Right? Or you're going to ask if you're going to opt into anything, you're going to opt in to become part of our membership site, right?
Interesting.
Site. So first one is you got to have it's a membership site that you're going to opt into, so only members can be of DIM. And the next thing is it's the accredited investor. We have to know whether you're sophisticated or accredited. It doesn't matter which one you are, but you still have to fill out.
Still have to know. So you ask some questions. You have them fill out a questionnaire, or they go one direction or another based on their answers.
Yep. And then after that, we have a real physical process where we have people from my company. We will now call them, right? And we are going to go over their financial questions. We are going to dig deep. Because it's not just enough to have a relationship. You have to have a financial relationship. In other words, we got to ask financial questions. If they are sophisticated, we need to understand their sophistication, right? And we do that with a pre-recorded line. So we log in that phone call, that conversation. I mean, we're really trying to document.
So you're recording that what's the word I'm looking for? That relationship building process.
Yep. We've got our emails, right? We've got a membership now. In the beginning of our membership process, they do not have access to any offerings.
Right.
Right. We have to go through a whole series of events where we talk to you and we're building that relationship, and we're tracking that using we use Infusionsoft.
But so do we. Yeah. Okay.
Right. We're tracking that process, that relationship building process, to where eventually we get to say, okay, we believe you're the right fit. We have a relationship, right? We've talked more than once. We have discussed financial matters. We understand who you are. You understand who we are. We will now grant you access to look at future deals, right? And now we have a vetted, documented process
Yeah, love it. Love it. Guys, that's really important. If you're going to do 506B, that you document the process so that
it
you
has
never,
to be.
yeah, you never want the SEC knocking on your door and saying,
We
hey,
do
how you
not look
doing?
at the stripes, brother.
No, none of us do. None of us do. Okay. All right. Well, that's very insightful and very helpful because, it's really not a topic that's even come up on this show before as to, sequencing that process. And so what other mechanisms do you use at the top of your funnel? You direct them to your website, you use your podcast. Are you doing anything else, or is the podcast enough?
No, the podcast's never enough in my mind. But so I just do old fashioned, okay, this is crazy, but go find a charity, go get involved in charity groups. So as a financial advisor, one of the things that Edward Jones had taught me was how to hang out where money hangs out.
Sure.
Right. One of the easiest ways is through philanthropy. And you don't just go join philanthropy because you want to go find money. Go find something that you really enjoy, that you really like. For me, I'm a Rotarian. I love going to Rotary. I love Chamber of Commerce. I love, there's a Friends of Mercy for my local hospital. There's a philanthropy arm. I actually help raise capital for that, Friends of Mercy. Right, I'm on their board. And it's not just enough to go. You need to get on their boards, right? You really need to be involved. Now, when you do that, business and relationships are going to happen. That's exactly what happens. And then in that, there is a process for us. So internally, so when, we build out these big networks, and we have investors all over the country, just like I'm sure you do as well. Sure. One of my favorite things also, so just doing that gets you out and without people. We're actually hiring employees to do this now for us. As an employee of my company that syndicates, my employees can go represent my company, right, and go talk to capital. So we're building that out more so now because we like those relationships. When we really want to get focused in Phoenix, truly, we want to be able to have a whole big army of investors in Phoenix, and we can have galas and events and treat our capital and do neat things for them, have tickets and games and sure.
All the big operators do that. I mean, they'll have parties. Yeah, it's relationship building. You have parties, you do all sorts of things. Love it.
And then one of my favorite things to do is that we pay quarterly checks, right? And we do not ever miss this.
Right, of course.
Either me or someone, it's really never me anymore. It's one of my team members. We will call. So every time we deliver a check within that week, we're getting a call and we're calling our investors. And one of my favorite lines that I make all my team and we train them to ask is, who do you know that I should know? And I love that line. Who do you know that I should know? John, now you've enjoyed, house. And we also start off with, we should always have an open. So one of the things that we train our staff to do is, what do you do for fun? When we're talking to our investors, we don't want to just talk about stocks, bond, and apartments.
Right.
And the easiest way to get off a different subject and find out what they really care about is, what do you like to do for fun? Rod, what do you like to do for fun? And Rod's going to tell me.
Right.
I'm going to write the note. And now I'm hoping that I'm going to try to find, something that we have a commonality on.
Right. You look for commonality. This is basic sales. You build rapport through commonality, and asking them what they do for fun is a fantastic conversation starter when you recall them.
And then that's the open. Yeah.
Right. Yeah.
The open is always, we're talking that. Then we get to investments, and then we finish. Rod, listen, we're trying to grow here. Who do you know that we should know?
I love it. No, love it. Guys, there's some real nuggets here.
To put a little bit better twist on it, who do you know that I should know? It's too big, by the way. Okay. If you say that, you don't put yourself in a spot. If I say, Rod, who do you know at the gym that I should know? Or who do you know that you go to masterminds with that I should know? If I put you in a specific place, then you can start seeing the people. Who do you know that I should know? It's too vast that you can't see anything. But if I put you in, who do you know that you go and play racquetball with? Who do you know that that
So
I should
you
know
could
that you
use
called.
that. You could use that activity. Like who do you know in boating or whatever. Whatever they told you.
Yes.
Yeah, got it. Okay, so yeah, no, and that allows them to actually think about it and maybe come
Well,
up with.
maybe John. I think John. And then once they say the person's name, right? What do you think is the best way for you to make a quality introduction for me?
Mm.
We like the word quality introduction.
Yeah, no, that's awesome pre-framing. Awesome pre-framing. Yeah, and guys, and this is why those of you listening that, if you're serious about this business, you really need to utilize a CRM. Both Corey and I use Infusionsoft. I've used Salesforce in the past, but it's very expensive. So is Infusionsoft, actually. Yeah. But there are free CRMs out there, or practically free, that you can use. Zoho, really simple systems, Insightly. Pick one and start using it. So that when you talk to somebody and you find out they like boating or golfing or whatever, and the wife's name is Helen, you're capturing all this stuff so you can instantly build rapport when you call back and then ask them those awesome questions. Who do you know that loves golf that I should know? And love it. Good stuff. Now, so you're training people to go out there and make these relationships. And what are you doing to maintain these potential investor relationships? Talk about your campaign to keep the list warm, to keep the investors engaged, to keep them interested.
Now we have it's a whole sequence, right? So because we use Infusionsoft, this is what I love about it. We have a whole series of emails that we include, like in video testimonials from our investors. So we have, don't take our word for it, listen to this guy, right? And his high quality video testimonial, right? Then we take them on journey. We show them past projects, right? We can talk about our past. Can't talk about future deals, right? But we talk about past deals. We don't ever usually, when they're new in the process and we've not said you get access, there's a limited scope of what we say and what we do.
Sure.
Right? Once we've finalized and said, yes, you are now have access to see all our new offerings, then we change the dynamic a little bit. But really, it's just through email, through text, and then honestly, it's just the old-fashioned. We have a built-in funnel that allows repetitive calls. We have a quarterly call loop, and that's really important for us, is a quarterly call loop. And
so it triggers you to remember to reach out and say, hey, what's happening? Just wanted to touch base, see how you're doing. Things are going well here, blah, blah, blah.
Yeah, and you just have to. And you let them know what, hey, because when you got one under contract or you're thinking about, hey, I think we're going to be getting close. Right. We want to start prepping them up.
Yeah.
And then once we actually get a deal, then we have a whole offering process. And here's something new that we're doing, Rod. I don't know if you're doing this yet. We just contracted with this company called IMS.
Oh, sure. It's a portal. That's a portal. Man. Yeah. Mm-hmm.
That's going to get implemented hopefully by next month. We'll have it up and going. And I can't even tell you how awesome that's going to be, because that's the level of sophistication that as you start growing lots of capital, and you do more than one or two deals, right? People are like, Corey, how many deals am I in? What deals am I in?
Right. It gives them a dashboard. It gives them a dashboard, lets them see exactly where they're at. Yeah, I actually just interviewed somebody for the show that has a different platform. I've got somebody in my mastermind that's created a platform that's going to go live soon, that just competing with people like IMS and Juniper and some of these other software platforms that allow you to have real connectivity with your investors. And so
think about Fidelity, right? You got a Fidelity account. Well, now you have a Kahuna account.
Right. Right. And by the way, it's what you just said is important. It allows you to white label it, so it looks like it's your platform. Even IMS, the software is going to look like hey, this is your platform. It really enhances your credibility and your image and everything.
Yeah,
else.
Because everybody wants to brag, right? So like we want our investors to be able to grab their phone and to their buddy golf say, hey, check this out. Here's what I'm doing. Let me just show them and scroll. And that's how we do it. Right.
Love it. No, I love it. IMS is not cheap. I know that. we're in between them right now. We're not sure which direction we're going to go right now, but they are very, very good. So good choice. Well, listen, brother, added a ton of value today. I really appreciate you being on the show, and really looking forward to staying in touch with you, my friend.
Again, thank you so much for having me. I appreciate it. Anytime you want me to have me on, I love this game of real estate. I mean, it's so fun. It gives you the two things that we all want, which is time and money and the ability to do big things and really create change.
Yeah, baby. All right, Big Kahuna. We'll talk to you soon, my friend.
Rock and roll, man. Thanks, bro.
All right, see ya.
Thank you for listening to the Lifetime Cash Flow Through Real Estate Investing podcast. If you've enjoyed the show, please take a minute to visit iTunes and leave your comments. For more resources or to connect with us further, please visit our website at rodkhleif.com. Tune in next week for our next show.
Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws.